Welcome to our State of the Market update for July 2024. We'll be talking about the capital markets and their performance over the last 3 to 6 months, along with an economic update, and then also talk a little bit about smaller companies and their relative performance over the last couple of decades and some things that we're seeing in recent research. So with that, we'll go ahead and dive in. Big picture, you can see that the markets weren't terribly volatile here over the last 3 months. The second quarter in 2024, the U.S. stock market was up about 3%. The international developed stocks, again, that would primarily be Europe, Japan, Australia, Canada, down about 0.7%. The emerging market stocks, for the first time in some time, had a really nice quarter and outperformed their counterparts there in the developed world. They were up a little over 5%. And then you can see the bond market, both U.S. and globally, was fairly flat. Over that time period, up just 0.1% in each case. If we drill down into looking at U.S. stocks, smaller companies actually were down about 4.7%, whereas larger companies were up about 4.4%. Now, you might say, okay, well, if you average the two, the U.S. stock market should be down a little bit. Well, smaller companies make up a much, much smaller part of the overall stock market than larger companies, and that's why that the entire index was up about 3%. If we look at large value companies versus large growth companies. The large value companies were down a little bit. Large growth companies, the NVIDIAs of the world, continue to post strong performance, up about 9.7% over the last quarter. International developed equities had a similar performance in that the smaller companies didn't do quite as well as the larger companies, but the gap was a little bit smaller. You could see the small companies down a little over 1%, whereas the larger companies were down about 0.5%. Value companies lagged their growth counterparts again, but by a smaller margin, just down 0.6% versus 0.3%. Turning over to the bond market, you can see that the rates of return that we're posting here are the first half of the year. So we're noting not just the last 3 months, but really 6 months. And a lot of these returns actually happened in the first quarter. You could see again that the aggregate index in the U.S. was up about 0.1% this last quarter. If we look at that aggregate index, there, the second from the right, the U.S. aggregate bond index down about 0.7% so far for the year. Didn't do much in that second quarter. And the bond index going into that third quarter, again, was down a little bit so far this year just because interest rates had risen. Now, they've reversed course a bit the last couple of weeks. We're filming this, in mid-July. So we've seen a reversal of course there the last couple of weeks. But to the end of June, we had seen the bond market in aggregate down 0.7% in the United States. The worst part of that was the longer dated U.S. Treasury bonds, the 30-year Treasury bonds down 6.2%, whereas the shorter term bonds, because they don't have as much of a interest rate exposure there, having a shorter term there, the 2-year U.S. Treasury was up about 1.1%, and the Treasury inflation protected securities posted a gain of about 0.7% increase there because there's an inflation component to that calculation, and because inflation was a little bit higher, remained higher than what people thought at the start of the year, again, that was a bit of a tailwind for that portion of the U.S. Bond market. Now, if we look over onto the reinsurance bond side of things, this would be, again, those bonds that are insurance against calamities, where you have some level of going alongside with insurance companies. These were up about 5.8%, that index at least for the first half of the year. And part of that is because the premiums have been fairly high, and the money market holding, the collateral account, has had a pretty nice rate of return there as well. So up about 5.8% again in that index. If we think about where the stock market sits right now in the United States relative to its history, we say, how expensive are stocks right now? If you've seen these state of the market updates in the past, you are familiar with this slide, but we think about the current price to earnings ratio relative to the last 20 years. And again, the question is, how expensive is it to buy $1 of earnings? What is the price of that? And how do we compare that over recent history? Well, if we look at where we were 1 quarter ago in April of 2024, going into that second quarter, you could see that the growth and large growth companies were fairly expensive headed into the last quarter, about 47% more expensive than history has been over the last 20 years when we think about that price to earnings ratio. In fact, growth overall was more expensive, of course, than value, and large companies overall coming into this quarter were more expensive than smaller companies. That trend has just amplified in the last quarter, with larger companies doing better than smaller companies, growth companies outperforming their value counterparts. So when we say outperforming, that just means that the price of the stock went up more than their peer group there over on the other side of things. So growth companies, even more expensive, those large growth companies, than where they sat in April of 2024. You could see other areas, small growth companies, for instance, didn't do nearly as well as their large growth counterparts, and so they're not as expensive, and their earnings did increase over the last quarter. So they're not as much of an expensive asset class when we look at them now versus history. And when we look at small companies, again, they're priced in line kind of with their historical norms, whereas larger companies still are expensive. Even the value companies, those larger value companies, still relatively expensive compared to history. But the large growth companies, they are quite expensive. Their price relative to their earnings. And that's driven by a number of different factors, the tech sector, and kind of this hope that AI is going to make things a lot more efficient, a lot more profitable. So for some of these companies is leading investors in that direction. If we think about asset valuations, and not just in the US stock market, but where they sit relative to history, and we think about the last 20 years, there's a complex formula and set of calculations that give us a Z-score. Anything north of 0 means that the asset class is a little bit expensive compared to history. Anything that is less than 0 means that the asset class is a little bit cheap compared to history. And this is kind of one standard deviation. On the left-hand side, you could see it goes up to actually 1.5 standard deviations in Z-scores, and down to -1 in terms of standard deviation off on the cheap side of things there. So the outcome that we look at, if we think about the end of the first quarter, or I should say going into the first quarter in 2024, where we started the year, the US bond market was a little bit cheap compared to history. And we look at it now and it's even cheaper than it was at that point. So we want to invest, if we have our druthers, we invest in those assets that are cheaper relative to historical norms rather than those that are expensive. But we also recognize that cheap bonds might not give us a better return than more expensive stocks, just because bonds don't tend to have given us as much of a return as stocks if we look at history in any rate. So the U.S. core bond market, again, this would be U.S. Treasuries, corporate bonds that are investment-grade corporate bonds. They're a little bit less expensive even than they were 6 months ago. When we think about municipal bonds, it's the same thing, because interest rates have increased over that 6-month time frame between 1st of January and end of June, bonds getting to be less expensive. When we turn the page and go over to the stock side of things, we see, though, because stock market returns have been fairly strong for the first 6 months of this year, that stocks have actually gotten a bit more expensive. So the gray bar there, international stocks were fairly cheap coming into this year relative to their history. They've become not quite as cheap. When we look at small cap equities in the United States, smaller companies, they've stayed about the same. They've gotten a little bit cheaper if we think about things over the last 6 months, whereas large companies in the United States have become a fair bit more expensive, and whether that be the value companies or the growth companies. So we look at all of that together and say, okay, stocks are not cheap. Be they in the US, be they larger or small companies. International stocks are a little bit more attractive relative to their historical norms. And then bonds are fairly attractive, again, relative to their historical norms, if we're looking at the big picture. We want to pivot now and talk a little bit about investing in small companies and how this has shifted over time, some of the options that we have now through private equity evergreen funds, and some of the research that's out there. Because what we always want to do as financial advisors is try to stack the deck in our clients' favor in terms of the odds of success and having strong investment performance. Now, if we go back over the last 100 years, we'd see that smaller companies have often outperformed their large counterparts. But there's some research that we'll be walking through here that can kind of help us parse through the nuances here of what's happened the last 20 years and also help us to think through what some options may be, again, in the private equity space. Now, we'd say at the outset, it's not for everybody. You need to really consider this in context of your financial plan and talk with your advisor about this, and also realize that it's still for accredited investors. So there's some qualifications here that you have to be able to go in this direction, but the barrier to entry is a fair amount lower.
Well, thanks for that intro, Spencer. So what we're going to start off by doing is we're going to look at the average annual return by small and large US companies over the last 100 years. And so you can see on the left-hand side of the screen, we're looking at the Fama French US Large Research Index from 1927 to 2023. That's in the blue on both sides. And then the US Small Research Index is in orange on the right-hand side. So left-hand side, the two bars are from 1927 to 2023. The right-hand side is the last 20 years. And so this data comes from the Morningstar article, What Happened to the Size Premium. We'll link it down in the description below. But throughout this presentation, as we talk about a premium, a small versus large premium, a value versus growth premium, that just means that as we've looked at historical data over time, what are those factors that influence maybe a small company outperforming or underperforming? What are those factors that influence value outperforming or underperforming growth? And so as we look at the last 100 years, you can see in the blue from 1927 to 2023, large US companies had an average annual rate of return of 10.1%. Those same small companies over that period of time had a rate of return of 11.7%. So you would say that the average annual premium there is 1.6% average annually. So over that entire 100 years, we've seen small companies outperform their large counterparts by about 1.6% year average annually. Now, this doesn't mean it happens every year, but over the course of history, that's been the factor. Now, on the flip side, if we look at 2004 to 2023, that hasn't been the case. Large companies have outperformed small counterparts by about 1.2%. So there is a premium in the other direction. Large US companies outperform their small counterparts 10.1% to 8.9%. So it really begs the question, what has happened to the small company premium over the last 20 years? And that's what we're going to dive into over the next couple minutes. So what has happened to small company premiums over the last 20 years? Well, what we need to do is we need to understand some of the market forces that have been at play over the last 20 years or so. And so as we think about this, we go back in time and we say, when Enron collapsed at the beginning of the 2000s, Enron was the 7th largest company in the world at the time, or in the US at the time. And if you can imagine today, that would be like Berkshire Hathaway going under. They're currently the 7th largest company in the United States. And so accounting scandals led to Enron and WorldCom's collapse. There were insider trading. There was all sorts of things going on. They were cooking the books. And so Sarbanes-Oxley Act of 2002 came in. And what it did was it increased the accounting standards across the board for publicly traded companies. They said, we want to protect consumers from bad actors. And so they came up with this act of 2002. And what that did is it increased the cost of publicly traded companies because they had to have additional audits being done. And so if you think about this, we'll look at this in another factor here. But what it does is if you are a really small company, your cost to perform an audit is going to be substantially higher relative to your revenue, relative to your earnings, than it might be for a large company. We think of what it could cost Apple to do an audit. Well, if they've got a tremendous amount of revenue, it's going to be less painful on a dollar-to-dollar basis than maybe a small company like Chewy's, who has maybe only about $400 million of revenue. So we think about that, and the cost of being publicly traded increases pretty exponentially for those small companies. And then there's research that's come out over the last 5 to 7 years that links the takeover factor, the potential for small companies to be taken over by larger companies through mergers and acquisitions, and what that has done to the small factor premium. So we'll take a look at that. So there was a study done by a company called Protiviti, and we'll link this in the show notes below if you want to take a look at this study. But this is the average internal audit cost by the size of company in 2022. This doesn't include any of the cost related to external audit fees. And so this is broadly across companies that were surveyed. They were asked different questions about what were your internal audit cost, how much time did you spend, kind of across the board. It was a really in-depth study. And so what you can see on that bottom line is if you were a very small company, you had less than $500 million of your company size, your average cost to perform your internal cost to perform an audit was right around $1 million, about $980,000 was your cost to run that audit. Now, if you were more than $1 billion, so that's 20 times the size of that $500 million firm, your internal audit cost on average was only about twice as expensive, running about $1.93 million. So you think about this, and we're going to look at just two companies here and compare them. And so I looked at a $500 million company in 2022. This was Chewy's, and their 2022 revenue was about $422 million. So I don't know what their internal audit cost was. I didn't look to see if they had that published. But if we use this average cost of about $1 million, then that means every $430 of revenue that they made, $1 is being pushed toward that average audit cost. Now, if we take a larger company and we say, okay, the Dollar Trees of the world, so they're about a $20 billion company, and their revenue in 2022 was about $26 billion. And so for Dollar Tree, that means every $13,000 of revenue that they generate, only $1 there is going to those audit costs. Again, using that average for more than $10 billion. So it costs more on a dollar per dollar basis if you're one of those smaller companies to be publicly traded. And so we think about all the costs that are associated post Sarbanes-Oxley of what it's done for these smaller companies. If you're not generating as much revenue, then on a dollar per dollar basis, it's going to cost more to run your audits.
We also need to recognize that this doesn't even include the external audit fees, so that could be a substantial amount more. It's also just more difficult for companies who are small to have PR firms engaged and be able to deal with the public, investors who are invested in them. If they're a smaller firm, they've got quarterly reporting that they've got to do. And the market has become a lot more focused on those quarterly numbers on that rolling time frame than it was, say, 20 or 30 or 40 years ago. So there's a tremendous amount more pressure to be able to meet those short-term numbers, which can more negatively influence these smaller companies, I think psychologically, probably even their management having their feet held to the fire, because these companies tend to be really focused on one particular arena of the marketplace. They don't tend to be, multinational firms that have all kinds of different, elements going on in different business lines. These tend to be already fairly focused firms, not having that wide array of different services or companies or what have you. But the quarterly element that they've got to report and they've got to defend, it probably has, I would guess at least, a stronger impact on just how well they can manage too.
Thanks, Spencer. So what we see here, if we come back to the Swedroe article, he says, the result is that by 2020, the number of publicly listed stocks had fallen 50% over the prior 20 years to about 3,500. And what we can see is we take this data from the World Bank via the Federal Reserve of St. Louis, and this is the number of publicly listed U.S. companies per million people going back to 1990. And you can see there was a rise through the 90s, but then as the dot-com bubble started to burst in the late 90s and 2000s, that number of publicly listed U.S. companies per million people starts to decrease in the early 2000s, decreases through the mid-2000s, 2010s, and all the way out to today. And so as population has continued to increase in the United States, the number of publicly listed companies continues to decrease as well. And so there's a concentration as well factor here at play, whereas you have less publicly traded companies per amount of people here, then the pain could increase if something were to happen to those publicly traded companies as well. So if we look at some of these research articles, then the argument goes the size premium is highly affected by the quality of the company. Higher quality small companies are more likely to outperform lower quality or junk stocks. And we need to pause here and say, this is fairly easy to say out loud. You think about the dot-com bubble and pets.com and firms that were running on little to no cash, very little revenue, low quality. A lot of those companies started to burst when the dot-com bubble burst. And you could say, yes, that quantitatively makes sense. What we need to reflect on here is measuring quality can be challenging. And so while it makes sense, we need to also just dive into, okay, this is true. So then what happens with those higher quality, smaller companies? And this research comes from a couple articles. One is Fact, Fiction, and the Size Effect. The other is Size Matters If You Control Your Junk. We'll leave description links to those articles. So if we look at that taking over the size effect, asset pricing implications for merger activity, they argue, quote, broadly, our results indicate that the traditional size factor can be interpreted as a proxy for a takeover factor. And so what their research did was it said, okay, we've seen historically over the last 100 years that size has outperformed. Small companies have outperformed their large counterparts. What they did was they said, okay, we know that there are other factors at play here, quality and value. And so they started to say, okay, if we were to operate these in a silo and say, let's pull out value, let's pull out quality, let's pull out profitability and see what actually is a factor that contributes to the size premium, small outperforming large. And what they saw is that the potential for a takeover actually positively impacted the premium for small companies. And so we extrapolate this a little bit further, continuing down the line of research that the authors of Taking Over the Size Effect did. And if we look at mergers and acquisitions by public companies, this is on the left side of the screen, of other public companies by decade. So we put all of this together and we look at it and we say, okay, small companies have likely been those that are exiting the market because it's becoming more expensive. And so 50% of those companies in the publicly traded market over the last 20 years have exited. Well, obviously, if there are less small companies, it's less expensive to take over a small company. So what you would see here, if we look at this data, is on the left-hand side of the screen in 1990, there were about 1,143 takeovers by publicly traded companies of other publicly traded companies. If you fast forward to the decade of 2011 through 2020, that number dropped by about 55% to only 506 publicly traded companies taking over publicly traded companies in that decade. So we're seeing a decline in public companies taking over other public companies. In that research, what they argued is that the bottom 40% of size of companies accounted for more than 50% of the takeovers. And so mergers and acquisitions really focus on that small framework, that small size of the stock market. And so if we look on the right-hand side of the screen, if you look at, okay, what's happening in mergers and acquisitions of public companies by their taking over private companies by decade. And we see a similar story from 1990 to 2000, 2000 to 2001, 2011 to 2020, there is a gradual decrease from 3,500 companies or so down to 2,600 companies. So we're seeing a decrease there as well. But on the flip side, where are we seeing an increase? It's mergers and acquisitions of privately held companies taking over other privately held companies. So where we saw a public to public decrease, a public to private decrease, on the private to private side, we're seeing an increase of about 10% from 1990 to 2020, going from about 7,200 1990 to 2000 to 8,000 in 2011 to 2020. And so their takeaway, if we look back at that Morningstar article, what happened to the size premium, the takeaway is that to capture the takeover premium in small companies, private markets in the form of private equities provide a greater opportunity than in public markets. So the logic here is that for the last 20 years, as smaller companies are leaving, if there is a premium to be had through mergers and acquisitions, if there are less small companies of quality that are being taken over in the publicly traded market, then the logical explanation that Swedrow comes to here is that private equity is a place where you can take over and see some of these premiums back at play. And so, Spencer, you want to talk us through where we're at today in the private equity market and being able to invest in private equities as compared to where we've been over the last maybe 20 years or so?
Right. So when I was in business school in 2008 to 2010, the private equity offerings, basically you could invest in a fund, and typically you needed to have millions of dollars that you were ready to put into a private equity fund. But you would put those resources into a fund, and typically there was a lockup period of at least 7 years, sometimes even longer. But they wanted basically long-term investors with significant assets and a significant risk capacity and risk tolerance to invest in these arenas, and then just trust the management team that all would go well and they would be paid out, in something like 7, 10, 12 years. That wasn't a great fit for our clients because we didn't want the lockup period to be that long. Typically also didn't want the allocation to be that high within client portfolios within private equity. Within the last number of years, though, there are more and more firms that are offering what are called evergreen private equity funds. And that just means that the liquidity is higher in these funds. Now, it's not still typically anything like day-to-day liquidity, but these firms are using interval funds, and they're usually having redemptions every 6 months or so in terms of the offering. So what you could do is you can put in a sum of money. Oftentimes, again, you're not being required to put in millions of dollars. There are some firms that you could put in $25,000 or $30,000 into a private equity fund. You put those funds in, so the barrier to entry is not nearly as high, both from an amount standpoint, but also from a liquidity standpoint. Just like with all equity investments, we encourage our clients to have that long-term approach. If they know they're going to need the funds in 6 months, we're not going to be advising them to put funds into private equity, nor into publicly traded stocks for that matter. But there is a higher capacity for liquidity, again, oftentimes having redemptions every 6 months or something like that in these interval funds. Now, there are other things to consider here. The volatility may be higher in terms of private equity. You may also not be able to get to those funds in 6 months because there are gates that can be put up in terms of the amount of redemption. So there's a lot of things that we've got to be very careful of, even as we invest in this way. But the barriers for entry are much lower now than they were even 12, 15 years ago, which is a good thing on the balance.
Yeah. And we'll come back here to the Swedroe article. And he talks at the very end of it that you may look at these private equity funds and it may look like volatility is less. But going back to Spencer's point, if you can only access those funds once every 6 months and they're not marked to market on a day-to-day basis, then it may look like there's less volatility, but you really have to take that into consideration as you're making these investments. So really, as you hear us talk about private equity, you need to take this to your own financial advisor. Really talk about this. Does this fit within your portfolio? Do you have access to this? Don't just take what we have said today and say, man, private equity seems great. I'm going to go dump my funds into it. Really take it in consideration of your long-term financial goals. And as we say every week, all of our advisory services are offered through Retirement Planning Services, LLC. Past performance doesn't indicate future results. Indices are unmanaged and cannot be invested into directly. If you have questions or comments today about any of our state of the markets, clients, if you want to talk to us about private equity investments and the potential there, we would love to have a conversation with you. As always, take care and we'll see you next time. If you like these financial planning videos, please share with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.